Gold just surged past 5,200. So in the next few minutes, I'll tell you what this signals, what it means for your retirement income, and the simple don't panic plan most retirees use. Your safe range, your next move if you own none, and the one rule that stops costly mistakes. Now, quick question, are you B, calm, worried, or confused? Comment one word and let's lock this in. When gold jumps like this, it can feel personal. Even if you don't own gold, it still hits a nerve because a move this big makes people think, what do the markets know that I don't? And if you're retired or close to it, you don't just wonder, what happens next? You wonder, does this change my plan? Or is it just noise? Here's the problem. A gold surge creates two dangerous urges at the same time. One urge says, I'm late, buy now. The other urge says, this is a top, stay away. Both urges push you toward emotional decisions, and retirement plans don't usually break because of bad investments. They break because of bad timing caused by stress. So today we're going to turn stress into a checklist. You'll know exactly what this gold surge might be signaling, how it affects the things retirees care about, income, inflation, and stability, and what to do next depending on which group you're in. And to keep this practical, I'm going to sort you into one of three groups. Say it out loud as you listen. Group 1, I own no gold. Group 2, I own some gold. Group 3, I might be too heavy in gold. In fact, comment un por two or now 3 right now. It sounds simple, but it forces clarity, and clarity is the antidote to panic. Now, quick reset. If you clicked this video because gold is at $5,200 and you feel the urge to do something, I want you to hear this clearly. You do not need to predict where gold goes next week to protect your retirement. You need a position you can live with in 3 scenarios: if gold rises, if gold falls, and if markets get messy. Let's start with what a gold surge usually means in plain English. Gold tends to surge when one or more of these things is happening. Investors expect inflation to stick around, the dollar is weakening, real interest rates are falling, confidence is shaky, or global uncertainty is rising. Sometimes it's a combination. You don't need to memorize that list. You just need to understand the retirement takeaway. A gold surge is often a signal that stability and purchasing power are moving to the front of the market's mind. And that matters to retirees because retirement has 3 jobs that must happen at the same time. Job 1, your money needs to help pay your bills, especially if your portfolio is part of your paycheck. Job 2, your money needs to keep up with inflation over a long period, not just this year. Job 3, your plan needs to survive stress without you making a big mistake. Gold mainly helps with job 3, and sometimes it helps with job 2. Gold is not designed to be job 1 because gold does not pay you interest or dividends by itself. That doesn't mean gold is bad. It just means we keep it in the right lane. Here's a quick keep watching moment. In about 1 minute, I'm going to give you a simple range most retirees fit into, and then I'll give you a 60-second checklist you can replay anytime gold makes headlines. So don't drift. This is about turning noise into a calm plan. Okay, now the numbers without hype. Most retirees who choose to hold gold typically fit into one of 3 ranges, not because these ranges are magic, because they're practical. The light hedge range, about 8% to 5% MUG. This is for retirees who are calm during volatility, prefer simplicity, and often have strong guaranteed income like Social Security plus a pension or other steady sources. The balanced hedge range, about a 5% to 10% MUG. This is where many retirees land because it's enough to matter in a storm, but not so much that it crowds out income-producing assets. The higher protection range, about 10% to 15% MI, sometimes up to 20% for specific situations. But for most people, above that starts to create new risks, like not enough income potential, too much dependence on one asset, and bigger emotional swings. Stop right here for a pattern interrupt. If your brain just said, tell me the perfect number, catch that. There is no perfect number. There is a range that fits your situation and your personality. That's what retirement planning is. Now I'm going to help you choose your range quickly. 4 yes or no questions. Answer in your head as I say them. If stocks dropped 30%, would you stay calm? Does your portfolio need to provide monthly income? Do you have strong guaranteed income that covers most essentials? Are you thinking about gold because you have a plan, not because headlines scared you? Here's the fast interpretation. If you're calm and your essentials are covered by guaranteed income, you can often stay in the neo 5% to young lane or even choose none, depending on your comfort and diversification. If you need your portfolio to produce income and you want a practical hedge, our 5 to 10% is often the most useful middle ground. If you're more concerned about inflation or currency issues, or you know you're stress sensitive in downturns, 10 to 15% worse may fit, especially if you can still maintain your income structure. Quick recap so far, you're not chasing $5,200, you're picking a range that keeps your plan steady. Now we go group by group. If you're group 1, no gold, here's what this surge means for you. It does not mean you failed. It does not mean you missed out. It means you should ask one honest question. Do I already have enough stability and inflation defense in my plan? Because some retirees do perfectly fine with zero gold. If you have a balanced stock and bond approach, a good cash reserve, and you can handle volatility without panic selling, you may not need it. But if market drops make you anxious, or inflation worries you, or you're heavy in stocks and light in defensive assets, a modest gold position can be helpful. Not as a bet, but as a behavioral tool. Because the biggest retirement mistake is not a bad investment. It's selling good assets during fear. Now, the biggest objection in Group 1 is always the same. Gold is already at $5,200. Am I buying at the top? Here's the calm truth. If you're buying gold as insurance, you don't need a perfect entry. You need a controlled entry that prevents regret. And that's why retirees should use a ladder method. If you decide you want a small position, don't do it all at once. Split your amount into 3 pieces. 1 piece now, 1 piece in about 30 days, 1 piece in 60 to 90 days. That's it. No drama. If it dips, you'll be glad you paced in. If it rises, you still participated. This reduces emotional whiplash. Now, Group 2, if you own some gold, this surge means one thing first. Check whether your gold has grown beyond your intended range. This is where people get surprised. You might have started at 8% gold. Then gold rises strongly while something else in your portfolio is flat. Suddenly you're at 12% or 15% without realizing. And now you're no longer holding some gold. You're drifting into heavy gold. So for Group 2, the most common smart move is not buying more. It's simply checking your allocation. If you're still within your target range, you may do nothing at all. If you're above your range, you rebalance calmly. Now, Group 3, if you might be too heavy, this surge can be a trap because it feels like confirmation. People think, see, I was right to go heavy. And that confidence can lead to oversizing even more. So let's do a quick test that never lies. If gold fell 15% next month, what would you feel? If your answer is, I'd panic, you're probably too heavy. Because gold can absolutely pull back 10-20%, even during long uptrends. A position that makes you panic on a normal pullback is not a hedge. It's a stress machine. If you're too heavy, the fix is not shame and the fix is not a dramatic sell. The fix is a target. Pick your range, then rebalance toward it. Now I'm going to say something that will protect you from the biggest mistake at all-time highs. When gold is making headlines, the villain isn't gold. The villain is pressure. Pressure from headlines, pressure from friends, pressure from social media, pressure from salespeople, pressure from your own fear of regret. Pressure creates rush decisions. Rush decisions create losses. So let's give you a shareable, pausable list of pressure red flags. If anyone says any of the following, slow down. Limited time offer, guaranteed returns, special retirement coin, or exclusive collector coin. We can't put total fees in writing. Don't worry about spreads and exit costs. Move your money today. If you hear that, you're not being advised. You're being sold emotion. Now, another pattern interrupt. If you have a spouse, friend, or family member who's been pressured around gold lately, remember this moment. This red flag list is the reason people share videos like this, because it's not about gold. It's about avoiding traps. Okay, now let's talk about what this gold surge might be signaling for your retirement reality. Not your politics, not your opinions, your practical life. There are 3 big retiree impacts that can come with a gold surge. Impact number 1, inflation anxiety. Even if inflation feels calmer some months, markets can be forward-looking. A gold surge can reflect long-term purchasing power concerns. Here's what retirees should do with that, not panic buy gold. Instead, make sure your plan includes assets that can grow over time and you're not overexposed to cash for long periods. Cash is useful for short-term stability, but long-term cash can slowly lose purchasing power. Gold can be one piece of the inflation hedge puzzle, but it's not the whole puzzle. Impact number 2, currency weakness. If the dollar weakens over time, imports can become more expensive, and global investors often treat gold as a store of value. You don't have to become a currency expert. You just want diversification so your plan doesn't depend on one perfect scenario. Impact number 3, confidence shocks. Gold can surge when investors feel uneasy about markets, debt, geopolitics, rates, or simply uncertainty. In those moments, retirees can be tempted to jump in and out of assets based on emotion, but the winning move in retirement is structure, a plan that can take a punch. Now, I promised you one rule that stops panic. Here it is, clean and simple. Choose the smallest hedge that keeps you disciplined, not the biggest hedge, not the most dramatic hedge, the smallest one that helps you sleep and prevents panic selling. Now we turn that rule into a quick stress test you can do anytime. Stress test A. If gold falls 20%, will you still be okay? Stress test B. If stocks fall 30%, will you still avoid panic selling? This is the real reason gold can help retirees. Not because it's guaranteed to go up, because it can help you avoid the most expensive behavior in retirement, selling quality assets at the bottom. Now we're going to make this interactive so your brain locks it in. Which is your main reason for considering gold, peace of mind, inflation protection, or market storm insurance? Comment, mind, inflation, or storm. Your reason matters because it affects sizing. Someone who wants peace of mind might only need 5%. Someone truly worried about long inflation cycles might be more comfortable near 10-15%. Someone seeking storm insurance might prefer a smaller but steady hedge plus cash reserves. Now let's talk about the how to own gold, because this is where retirees can accidentally buy the wrong product. There are 4 common ways people get gold exposure. Physical gold, coins and bars, tangible, real, and some people sleep better with a small amount. But physical comes with premiums, storage, and security. If you go physical, keep it simple. Avoid overpriced collectibles unless you truly understand what you're buying. Gold ETFs, simple, liquid, easy to hold in a brokerage account. For many retirees, this is the cleanest way to maintain a modest allocation without hassle. Gold mining stocks, not the same as gold. Miners are companies. They have business risks, management risks, cost risks, and they can drop hard in market sell-offs. If your goal is stability, miners are not the same tool. Gold in retirement accounts can be appropriate for some, but this is where fee complexity and pressure tactics can show up. If someone can't explain total fees, spreads, storage, and the exit process clearly, you walk away. Quick recap. Pick the allocation first, then choose the simplest vehicle that matches your comfort and avoids pressure. Now we're going to do a fast choose your type moment because it increases retention and makes the advice feel personal. Susan is 66. She has Social Security and a pension. Her essentials are covered. She wants simplicity, and she stays calm. Susan often stays in the light to middle zone. Mike is 71. He has Social Security, but no pension. His portfolio needs to support his lifestyle. He wants a hedge, but he can't sacrifice the portfolio's ability to work. Mike often fits in the 5 to 10% zone. Linda is 69. She worries about inflation and long-term currency risk. She wants extra resilience. Linda might choose 10-15%. But she still avoids extremes because she understands the income trade-off. Which one are you? Comment so, mom, or la. And if you're in between, pick the closest. Now, here's a critical point that retirees often miss. The decision isn't buy or sell at $5,200. For most retirees, the decision is rebalance or hold. If you are within your target range, holding may be perfectly fine. If you are far above your range, trimming back to your range can be smart, not because you hate gold, but because you respect risk. If you have none and you want a modest hedge, laddering in can be smart, not because you're chasing, but because you're building structure. Now we add one of the most powerful retirement techniques, rebalancing. Rebalancing is how you win without predicting. If your target is 10% gold and gold rises until it becomes 13%, you trim it back to 10%. If gold falls until it becomes 7%, you add back toward 10%. You're not guessing. You're maintaining structure. A simple rule that many retirees can follow: check twice a year. If your allocation drifts a few percentage points from target, rebalance. Boring is good. Boring is safe. Pattern interrupt. If your brain just shouted, but what if gold goes to $6,000? Notice that's the prediction brain. Retirement rewards the plan brain. Bring it back. Target, ladder, rebalance. Now let's handle a big concern. What if I pick a target and I'm wrong? You're not wrong if you use ranges and rebalance. You're only wrong if you go extreme and stay emotional. The entire purpose of a range is to allow normal market movement without turning every week into a crisis. Now, I'm going to give you a shareable signs you're too heavy in gold list because it helps people self-correct without shame. If you check gold prices daily and it changes your mood, you're likely too heavy. If you feel relief when gold rises because you're afraid of everything else, you're likely too heavy. If a 10-15% gold drop would ruin your week, you're likely too heavy. If gold has become your main conversation topic, you're likely too heavy. If that's you, the fix is calm. Pick your target range, then rebalance back to it. You don't need drama, you need discipline. Now the opposite list, signs you might benefit from a small hedge. If you panic during market drops and you've sold at bad times before. If inflation worries you and you have no diversifier besides cash. If you keep too much cash long-term because it feels safe, but you know it loses purchasing power over time. If any of those are you, even a 5 to 10% hedge can change your behavior in the next storm. Now pause, because this is the save this part. This is where the video becomes useful months from now, not just today. Here's your 60-second retirement response checklist to gold headlines. First, identify your group. No gold, some gold, or too heavy. Second, choose your target range. Most retirees who use gold choose 5 to 10% as a practical hedge. If you're more concerned and you can support the trade-off, 10 to 15%. If you're calm and covered, 0 to 5% can be fine. Third, run the stress test. Can you handle a 20% gold dip without panic? Can you handle a 30% stock drop without selling low? Fourth, if you're adding now, ladder in. Now, 30 days, 60, 90 days. Fifth, choose your simplest vehicle, ETF for simplicity, small physical, if it helps you sleep. Avoid confusing miners with gold and avoid pressure products. Sixth, rebalance twice a year. Trim when hot, Add when cold, back to your target. That's your plan. Calm, repeatable, no guessing. Now I want to give you a short sentence you can use whenever someone pressures you. This is your retirement shield. Say it out loud if you need to. I don't move retirement money under pressure. I choose an allocation, I ladder in, and I rebalance. If you can't explain total fees in plain English, I'm not interested. That sentence alone can save people thousands. Now let's bring it back to the title and say what gold past $5,200 really means for your retirement. It may mean inflation expectations are still alive. It may mean investors are uneasy. It may mean the dollar is weaker. But for your retirement, the meaning is simpler. It's a reminder to check your structure and make sure your plan can handle stress without requiring perfect predictions. If you are within your target, you don't have to chase. If you are at zero and you want a small hedge, you don't have to time it. Just ladder in. If you are too heavy, you don't have to panic sell. Just rebalance. Now here's a question that's going to reveal whether your plan is truly stable. Answer honestly. If gold dropped 15% next month, would you buy a little more or would you panic? Comment. Buy. Or keep caught. Panic. No judgment. Your answer tells you whether your position size matches your temperament. And I want one more comment from you because it helps everyone watching and it helps me make the next video better. What's your target after hearing this Spruce, Fafris, Tetris, or 15 tours? Just type the number. If you're staying at zero, type topics. Now, if you want part 2, I'll make it next and keep it extremely practical. Gold versus cash versus bonds for retirees, what each one is for, how to size them, and how to avoid the most common traps. Comment. Part 2. And I'll write it. And remember, retirement isn't about being the smartest person in the room. It's about being the calmest person with a plan you can stick to, whether gold is at $5,200, $4,200, or $6,200.